Thank you, Steve. And I thought, before we start, I was being vaguely trendy today by wearing a cape, but a number of my colleagues have pointed out that I actually look like a professor from Hogwarts, so I do apologise for that. It's not meant to be a lecture, or hopefully you'll feel that way by the end anyway. Anyway, so to start, good afternoon everybody, and welcome to the Investment Supervision and Policy Division segment of the Commission's Industry Seminar. Speaking alongside me today, I have my two deputies, Mark LePage and Louise Bugall, and I'm also pleased to have with us on the panel John Dunford. John is the Deputy Director of the Authorisations Unit at the Commission, and I will touch on authorisations in more detail a little later. But John is here to answer any questions you may have about the Authorisations Unit, or indeed the authorisations process itself. But before we rush to get to the questions, which we'll take at the end, what will myself, Louise and Mark be talking about? Basically, we're going to have a quick canter through all the activities we undertake, and taking the theme of this year's presentation, Island Economics, Productivity and Prosperity, it will hopefully be self-explanatory as to how the activities we undertake and which we describe to you today contribute to the prosperity of our island. I will start by providing an overview of the division and including, as I say, how we interact with the Authorisations Unit. I will then talk about the sector and in particular the challenges facing the sector. Following me will be Louise, who is going to talk first about policy, and it wouldn't be a presentation from investment without us talking about AFMD and MiFID, and then she will comment on her IOSCO work. Mark will bring up the rear with some discussion around our domestic work, including risk-based supervision and the PRISM methodology, highlighting the trends we've seen through our supervisory work this year. He'll also discuss the first thematic we commenced in early October and our plans for future thematics. Mark will wrap up his section by running through a case study with us trying something a little different this year. We are often asked to share examples of behaviour that we come across, anonymously of course, and we understand that it is valuable feedback for you to receive. I'll leave Mark to elaborate further in due course, but I would like to thank the willing, volunteers from amongst my team for their participation. And it is not true that this is the reason why Nick Herquin recently moved from our division to take up the Deputy Director post in the Financial Crime Division. So, starting off, let's have a look at the division. For those of you who attended day one of the industry seminar yesterday, you will have heard William's speech, and I hope you will be reassured to hear that at least 3 members of my team, as well as being high calibre staff as well as the rest of the team, also spent their school holidays picking, bunching or packing flowers in the greenhouses of Guernsey, which they tell me is very much harder than the cosy world of supermarket shelf stacking that I had to endure. This organogram shows the makeup of the division as we currently stand at 16 in number. But stripping away from the personnel themselves and focusing on the activities, you will see since the introduction of risk-based supervision, we have changed the structure of the division away from one where the teams were driven by function, being monitoring, on-sites and applications, to one where the focus is on the impact rating of the entities. The final step in the process was the move of the applications out of the division across to the centralised authorisations unit. Now, from a practical point of view, in terms of you contacting us, we still do have the very well-established email addresses for submitting notifications. However, you may have heard Stephen Cole, our Chief Operating Officer, describe this morning how a number of the notifications may now well be submitted via our newly launched online submissions portal. A list of those notifications that are live for submission via that route is available on our website. We are, of course, still contactable by phone, and if you're in any doubt as to who to speak to, as a general rule of thumb, please call the help desk for support around operational issues on the portal, both for online submissions and PQs. Their number is on our website. And for supervisory matters, please contact anyone in the investment division, and they will either respond to your query or pass you to the appropriate person. The resources in the division are already shared between teams, and over the coming 12 months, I expect there to be further merging of the teams shown here, allowing us to flex our resources to apply them even more effectively where they are needed. As I said, the applications function was moved from the division into the authorisations unit in May this year, which is the point at which the authorisations unit was fully formed into its current role, including taking on the applications work of the other supervisory divisions. This slide shows that the Authorisations Unit has been very busy since its establishment. The move of work was also accompanied with the move of 2 members of the division. As it stands today, 8 members of the Authorisations Unit have worked in investment at some point in their career at the Commission. The Authorisations Unit may well be well stocked with staff experienced in handling investment applications, but that does not mean that we have removed ourselves from the process entirely. The Investment Division is still very much available to speak to applicants or to accompany our colleagues in the Authorisations Unit to meetings with new promoters or indeed to consider new policy questions arising as part of applications. This connection and collaboration between the 2 teams is crucial for ensuring we are forming policies correctly and ensuring that there's consistency between the applications and ongoing supervision. The Authorisations Unit has adopted the same approach as the Investment Division held to applications. That is, to meet deadlines requested as far as they possibly can. However, when they are busy, and they have been of late, which is a good state for them to be in, it may not always be possible to meet the deadlines asked of them. Very often these requests being timeframes very much shorter than the statutory requirements. And I would just ask you to bear that in mind and be realistic in your requests when you make them. The next couple of slides show the tentative statistics as at the end of September. As they are hot off the press, so to speak, I have put a caveat on both slides, but they are now unlikely to change. And I would also like to point out that it occurred to me last night when I was doing my final run-through, the hyphens on the slide are simply hyphens and they're not meant to indicate negative figures. Especially so, as I'm very pleased to say that the funds under management for the quarter ending September 2015 have increased to 224.8 billion from the 219.9 billion in the previous quarter. And this is as a result of uplifts in each of the 3 fund types. This increase in the funds under management was also matched by a very slight increase in the number of open-ended funds and closed-ended funds in existence. So moving to the statistics for the asset managers. Again, these statistics are as at the end of September with the same caveat and indeed the same comment about the hyphens. It will not have gone unnoticed by many of you that the statistics for the asset managers has increased significantly over the previous few quarters. I have referred to this as we've issued the stats on the news releases on the website, but just to reiterate, it's largely due to the submission of data from entities that had not previously supplied the information to the Commission. But why are they suddenly submitting this information to us now? The reason is it's an example of how our shift in focus through risk-based supervision has brought us into closer contact with entities where it's previously been limited. And that increased contact, through it, we have identified the non-submission of statistics. The statistics are positive for the quarter ending September, which is great news, but there are, of course, still challenges facing our sector. Historically, the Investment Division has approached the funds, together with their service providers on the one hand, and the asset managers on the other, as 2 really distinct elements of our sector. Mark will comment later on how our use of risk-based supervision means any entity licensed under the POI, regardless of its main business area, will come under our supervisory focus dependent on its impact rating. Similarly, I think the challenges facing both sides of the sector are now merging. For example, but none of this will be new to you, changing investors. There have been a number of recent studies and reports highlighting the changes we are seeing and can expect to see in investors' profiles and demands. Institutional clients are our bread and butter. However, the retail sector still exists, and anyway, are the demands and expectations of both client bases that different? We are being told, according to these reports, that investors are looking for brands they can trust. The Guernsey brand, perhaps. An important buying criteria for all clients are, or will be, simplicity, transparency, honesty and integrity, all factors as a jurisdiction we strive to be known for. Other challenges include international pressures. Louise will be covering the challenges of AFMD and MiFID II on both sides of the sector, and you are all more than aware of the regulatory pressures come in other forms than just regulatory pressures. There's a whole raft of other international pressures too. Technology is another challenge. Expectations of retail investors will be for 24/7 connectivity and access to relevant and timely information. But will institutional investors' requirements be any different? In markets, we're facing challenges too. The opportunities for investment with acceptable returns are diminishing. The debt and bond markets are both still dampened, and investors may be more prepared, therefore, to consider non-traditional savings products. Institutional investors will expect Guernsey to be ready to accommodate alternative products, and Gillian Browning will speak later this afternoon about innovations and the Commission's role in the island's initiatives. Finally, competition. It is ever increasing, and entities are having to move more quickly to keep pace with some of the challenges I've described here. But that's also in face of the increasing competition on individual firms, as well as on a jurisdictional level. Indeed, we've seen locally this year movements of books of business or mergers within the island itself, alongside the loss of business off island, together, of course, with the wins of business moving here. How can these challenges be further turned into opportunities? Well, technology and competition are two challenges which I will commit to try to turn to our advantage. I've mentioned earlier the advent of the Commission's online submissions. This in time, hopefully indeed from the end of Q4 this year, will be extended to the statistical returns for POI licensees. The opportunity arising from this will be the ability to better analyse the statistics provided. A member of industry commented to us recently that we do not use our statistics to the best purpose. For example, we are not highlighting the new launches, and I agree. Whilst I hope the online submissions will make the analysis easier, I'm also prepared to commit resource now to review these statistics to identify the data that is more positive in nature, albeit that we've seen a positive outcome this quarter. That said, I do have to be careful not to breach any confidentiality in the information we provide or release via the statistics, and so that is where you come in. When I initially drafted this speech, I was going to ask that if you're aware of the good news stories, the launches, the new promoters to the island, to please share them with Guernsey Finance. Of course, before I could ask, you already did so, and it was pleasing to see the headline in the Guernsey Press on the 5th of November, "Fund assets down, but the future bright." Instead, today, I will encourage further articles of this nature, particularly as I say that this quarter the statistics are up on nearly all accounts. I will ask that you issue your own news release, or if innovative in nature, share it with the FinTech Digital Oversight Group. I am of course aware of things in the pipeline that I cannot share with you, but you are in the position to do so. In the meantime, my team will take a more in-depth look at the statistics to determine where the good news is, and share that as far as we can, or at least try to point people in the right direction. It may appear to be a minor thing, but it is a start, and by working together through the better presentation of statistics and by releasing good news stories, it will add to our prosperity by raising the brand of Guernsey. I'll thank you all for listening, and I will now hand over to Louise to cover our policy and international activities.
Thank you, Emma. So, international policy. I thought I'd start with a quote that I recently saw that I thought described our international activities. "I live my life in widening circles that reach out across the world." So, AIFMD. ESMA issued its advice on the extension of the passport to non-EU AIFMs and AIFs on the 30th of July this year. The advice relates to the possible extension of the passport, currently only available to EU entities, to non-EU AIFMs and AIFs, which are currently subject to the EU national private placement regimes. ESMA conducted a country-by-country assessment, and this allowed it flexibility to take into account the different circumstances of each non-EU jurisdiction regarding the regulatory issues to be considered, such as investor protection, competition, potential market disruption, and the monitoring of systemic risk. ESMA initially only assessed 6 jurisdictions: Guernsey, Hong Kong, Jersey, Singapore, Switzerland, and the United States of America. So why were they selected? They were selected based on a number of factors, including the amount of activity already being carried out by entities from those countries under the national private placement regime. EU national authorities' knowledge and expertise of dealing with their counterparties and the efforts by stakeholders from these countries to engage with the ESMA's process. The advice concludes that no obstacles exist to the extension of the passport to Guernsey and Jersey, while Switzerland will remove any remaining obstacles with the enactment of pending legislation. No definitive view has been reached on the other three jurisdictions due to concerns related to competition, regulatory issues, and a lack of sufficient evidence to properly assess the relevant criteria. So how did we achieve this positive outcome? Well, by a major effort by the jurisdiction and not just by Commission staff. By, for example, responding to ESMA's call for evidence and pounding the streets of Paris and Brussels together with colleagues from government and SIBO, talking to ESMA and the EU Commission about passporting. What's next? Well, the advice and opinion have been sent to the Commission, Parliament and Council for their consideration on whether to activate the relevant provision in the AIFMD, extending the passport through a delegated act. However, the institutions may wish to consider waiting until ESMA has delivered positive advice on a sufficient number of non-EU countries before introducing the passport in order to avoid any adverse market impact that a decision to extend the passport to only a few non-EU countries might have. On the 13th of October, the European Parliament's Econ Committee had a security meeting with Stephen Major, Chairman of ESMA, and Sven Gettner, Head of Unit of C4 in DG FISMA, as well as the team of rapporteurs. It provided the greatest clarity to date on the development of a delegated act on the extension of the AIFMD passport to third countries. In summary, the Commission has been given ESMA until March 2016 to complete the assessment of Hong Kong, Singapore, and the USA, and also to assess a second wave of third countries: Japan, Canada, Australia, Isle of Man, the Cayman Islands, and Bermuda. A second opinion on the functioning of the EU passport will be conducted in the second half of 2016. Wider criteria such as fiscal, AML, and CFT will be taken into consideration by the Commission. The end of the national private placement regime 3 years after issuing the passport will not be automatic. And of course, our AIFMD regimes are in place and being enforced, demonstrating the substance to our regime. So we're in a good place. On to MiFID II. It's not a who, darling, it's a what. My eldest daughter, Charlotte, asked me recently who MiFID was, as when we were in Waitrose or in the high street at the weekend, I'm stopped and asked how MiFID is going. So here goes. 2015 has seen some clarity, but some uncertainty remains, and MiFID II remains a moving target. 2015 has seen a number of public consultations coming out from ESMA and Her Majesty's Treasury, consulted in the first half of the year. We, as regulators, acknowledge the pressure of ESMA's workload, which has resulted in a number of delays to the Level 2 and Level 3 draft technical standards, implementing measures, and delegated acts. The list goes on. The most significant of these was a delay of 3 months to the final submission of regulatory technical standards to the European Commission, resulting in the publication in September rather than July. In terms of timing, 3rd of January 2017 is written in legislation and is when the obligation takes effect in the EU. which means the national laws and rules have to be in place by July 2016. The delays in finalising level 2 and 3 could result in the endorsement by the EU Commission and scrutiny by Parliament being finalised as late as the first quarter of 2016. Stephen Major, the chairman of ESMA, in his speech to ECON last week, talked about the implementation challenges in the run-up to the implementation date of MiFID II. He didn't intend to surprise anybody in the room when he said the timing for stakeholders and regulators alike to implement the rules and build the necessary IT systems is extremely tight. He has formally written to the European Commission setting out the reasons for such a delay, and as of yesterday, that letter is available on the ESMA's website. So we remain on tenterhooks. The timing of an announcement from the European Commission will be key, and is probably not expected before March 2016. If the delay were to be granted in mid-2016, this would be too late for most. Until the European Commission officially announced a delay and the details of what is delayed, all, some, nothing, we should continue to work towards a 3rd of January 2017 implementation. So the target keeps moving. Uncertainty as to what the third country equivalence process looks like and when such assessments will commence remain. Though the pain of MiFID implementation may be delayed, it still cannot be denied. So what are we doing? We continue to work closely with our counterparts in Jersey and have been aligning our responses to ensure an appropriate response to the challenge of MiFID II to maintain competitiveness of both islands. Our engagement goes beyond Europe, so when in the neighbourhood, we discuss MiFID II with such people as the SFC in Hong Kong and ASIC in Australia. The revisions of law workstream and our response to MiFID II are interconnected, and due to uncertainties of timings, we, fortunately, have adopted a flexible approach. We anticipate that any changes required to our regime can be achieved at a rule level rather than primary legislation, but have anticipated any primary legislation changes in our consultations. So, next steps. We're aware that the FCA still intends to consult in December of this year and early next year, and we will look at with interest at the changes they propose to make to their regime. We will continue to engage with the FCA, HMT and ESMA. Any substantial updates will be tweeted by the Commission, so I urge you to subscribe. But don't worry, you'll be hearing from me and other colleagues again, as and when we have further information, and we will be holding further presentations to highlight proposed changes to our regime. So on to IOSCO. I sit on both the screening group for the Multilateral Memorandum of Understanding, MMOU for short, and the Committee 4 on Enforcement and Exchange of Information. So what have we been up to? Committee 4, in June of this year, IOSCO published its report on credible deterrence, which identifies key enforcement factors that may deter misconduct in international securities and investment markets. The report draws on the collective experience and expertise of IOSCO members and was produced by the committee I sit on. It identifies the key elements in the prevention of misconduct and financial crime from a range of international regulatory authorities and encourages regulators to consider how they might integrate credible deterrence into new or existing enforcement strategies. As we know, credible deterrence should be a key component of any effective enforcement strategy. Deterrence is credible when would-be wrongdoers perceive that the risks of engaging in misconduct outweigh the rewards, and when non-compliant attitudes and behaviours are discouraged. I'm sure Simon will agree. The report includes real examples of effective approaches to achieve deterrence, including timeliness of enforcement intervention, individual accountability, and robust sanctions, and is available on the IOSCO's website. So what next for Committee 4? Well, we're considering a number of new mandates, including mutual recognition of security regulatory decisions, which is exploring the capacity for mutual recognition of regulatory decisions. We're also considering guidance on compelled testimony, considering the practical benefits of better understanding the ability of regulators to compel testimony in response to a request for assistance from an overseas regulator. As I said, I also sit on the screening group responsible for applications to sign the IOSCO MMOU, which has resulted in two jurisdictions being able to sign at this year's annual IOSCO conference. We're also working on an enhanced MMOU, and this has been the main focus of the screening group in addition to the consideration of applications. The current IOSCO MMOU, to which 105 jurisdictions are now signatories, was established in 2002 to create an international benchmark for cross-border cooperation between securities regulators on the investigation and deterrence of financial misconduct and fraud that can weaken global markets and undermine investor confidence. The MMOU is the centrepiece for IOSCO's effectiveness, and it has been the experience of the signatory jurisdictions in meeting the challenges of the globalisation and rapid advances in technology that has identified the need to lift the bar and implement an enhanced MMOU that encourages security regulators to adopt a broader and more future-proof range of powers to support international enforcement, cooperation and assistance. In the intervening 13 years, there has been significant changes in the complexity, sophistication and size of global financial markets, and in the technology that both facilitates and potentially disrupts them. There has also been significant change in regulatory structures, legislations, and tools to combat misconduct. So it's now time for an enhanced MMOU to ensure the international cooperation at a high level is maintained, and as the name suggests, is enhanced. So I suppose the question that many of you are sitting in the audience asking is, well, why do we bother with IOSCO? Well, by participating in and contributing to various bodies, including IOSCO, that cover the financial service regulatory landscape, our aim is to punch above our weight, thereby ensuring that we protect and enhance the bailiwick's reputation and influence, resulting in being seen as a credible international jurisdiction. I cannot underestimate the networking opportunities, thereby giving us the leverage to get in front of the right people. Ultimately, it shows us as a good neighbour. We would like to share a photo of our international travel. Unfortunately, William vetoed our suggestion to emulate the Australian regulator's coffee break entertainment, but I've been allowed to show a photo anyway. Thank you for your time, and I'll now hand over to Mark for something a little bit different.
Not least, I can assure you, ladies and gentlemen, that I won't be about to dress just like that. Thank you, Louise. Anyone who knows me realises that at heart my instincts are libertarian, sometimes a little bit controversially so. but I have been very encouraged and willingly contributed to the changes that this Commission and our division has made to ensure that our regulation remains professional and proportionate. I remain convinced that risk-based proportionate regulation underpinned by caveat emptor can be supported, and of course our statutory obligations now clearly enshrine this approach. I remain convinced for several reasons. As Simon said yesterday, enforcement cases do remain a small minority of the population, and I have to say when I was sitting in the courtroom that Simon was talking about yesterday, I did have to remind myself of that on a couple of occasions. But not only that, PRISM has done what it said on the tin. We have been able to anticipate problems before they arise, rather than react after events. From stockbrokers to administrators, we have sought to bring rigorous challenge and to understand just how you make your money and where those risks are. I've been particularly heartened how many of you have responded well to our approach here and have been quite prepared to discuss issues openly with us in the knowledge that we are not trying to trip you up, but rather to maturely and responsibly supervise you. So for the forthcoming year, if you are meeting with us, you can expect more of the same approach. In particular, if you're an administrator or custodian, we will be particularly interested to see how clearly you can identify those risks that are inherent in your funds, and most specifically, the distribution channels through which those funds have been sold. So to borrow Jean Tirol's terms, the role of ex-ante supervision is just as crucial as ex-post enforcement. So what can I tell you about the last year? I can tell you what we have found and what we are in the process of doing. Our main findings, or as we now call them, risk mitigation points, can be placed in the following major areas of risk, going from the bottom up: operational, governance, strategy and business model, conduct, and financial crime. But have there been any overarching themes over the last year that these risks have pointed towards? Well, the answer is yes. There has been a need for us to ensure that there is sufficient board oversight of compliance monitoring and risk, and similarly, that there are sufficient controls in place around outsourcing. At the risk of giving the game away for what is about to occur in a few minutes' time, I will leave our eminent actors to expound further in a few minutes. As many of you know, on 8th of October this year, we commenced our first thematic. We have decided to focus this time on alternative custodian arrangements for open-ended funds. Now, I want to be clear here, whilst I cannot personally see the Commission depreciating its appreciation of the oversight role of a custodian, we do adopt a flexible approach for schemes with certain asset classes and investor types. So we have designed this thematic to look more closely at those waivers issued in respect of alternative custody arrangements, for example, where prime brokers have been appointed. And we are testing how this oversight responsibility is working in practice. Now, last Friday was the deadline, so we are now in the analysis stage. However, I must be honest, it is too early for me to comment in detail right now. But I can say that the number of responses is slightly lower than what we were expecting. So my colleague Dawn Seeley has asked me to say that there is still time to submit a response. And this is me talking now for once. There is no late piling penalty, ladies and gentlemen. So we will be arranging some visits, and we intended to communicate our thoughts to you in Q1 next year. So in Prism World, we will conduct a thematic annually. And other areas that are currently in our minds include the following: difficult to value asset classes, and also, liquidity in funds, that is just how well liabilities match the assets. Now in the past, and I note there are two of Emma's predecessors sitting in the room, this would come the slot where we would give some examples and try and look at the guilty parties as we were talking about the examples. Well, neither Emma, Louise and I have quite managed the squinting, stern looks of our predecessors. So this year we thought we would do something different and hire some talented actors to sketch out a hybrid, and I must stress this is a hybrid, of some of our favourite interview moments of the year. 3/4 of the way through the vignette, I will attempt to stop the video. Anybody who knows me knows that I have broken every single computer that the Commission has given me, so this could get quite interesting. But we will attempt to stop the video, talk about it, and roll it on. So, ladies and gentlemen, for those of you who like to ask consultants what a prison visit means, we're about to save you some money.
Firstly, thank you for your time this morning, John. This meeting is part of our engagement plan for a medium-high impact firm and is being carried out at this point in preparation for a full risk assessment that we're looking to do in the next year. Dawn and I have a set of questions that we'd like to ask you, and what we're looking for is to get a better understanding of the compliance function, and in particular your role as the compliance officer of ABC Investment Management Limited, but also of a number of other POI licensees. So unless you have any questions, I was going to pass to Dawn with the first question.
Sounds good, thanks.
Okay, thanks Amanda. Hi John. If you could just run us through really what your understanding of the business that's currently undertaken by ABC Investment Management Limited, that would be really useful.
Sorry, I'm a bit rusty. I've literally come off my holiday, so I'm on a 2-week holiday, and I've just come in just for this day. So sorry, I'm just a bit stuck there. It's an investment manager of private clients. That's in a nutshell what it is.
Okay. Well, maybe if I expand a bit, we noted that there have been a number of fundamental changes to the business model of ABC. Perhaps you could explain how your approach to compliance monitoring has changed to accommodate this?
I mean, the biggest change, as far as I can think of, is that there's been a number of staff that have left. So we've reduced by half, probably. But I don't think there's really been much change to the business model itself. It's an investment manager. It's a licensee, so it just needs to comply with all the rules and regulations. So I've got a nice spreadsheet with all the rules, and I can tick back on each one on a weekly, monthly, quarterly basis. But that's probably as far as it goes.
Okay. Where would you say the majority of ABC's clients are sourced from?
I'm gonna have to get the file out and check. Sorry, like I say, I've just come back from holiday. I mean,
Sure.
I can't be expected to remember all the clients.
You don't know them. Okay.
I'm sure they're fine. Medium low.
That's interesting you talk about risk. Could you describe the overall risk appetite of the firm?
Yeah, I'm really proud. I've got this business risk assessment, required by the AML handbook and regulations, and it sets out all our sort of financial crime risks, and yeah, it comes out as medium low. So.
Okay, so I mean that covers AML risk, but general risk appetite, other areas maybe?
That's not really my job. I've got the licensee conduct business rules. Like I say, it's all tied back. I don't think it needs to be risk-based because we need to ensure compliance with every single rule. So that's what we do. But yeah, certainly on financial crime risks, I mean, that's all done. So.
Yeah.
I think moving on to a slightly different area, as you'll be aware, the Guernsey Financial Advice Standards came into effect at the beginning of this year, and we just wondered what implication the GFAS requirements have on your business and what impact they have had on your compliance monitoring program. I mean, have you had to make many changes to the compliance monitoring program?
Yeah, I mean, certainly we're an investment manager stroke advisor, so yeah, I mean, it's very, very important. I sat down with one of the directors and I said, well, we got this, we're an investment manager, we better look like we're doing something. So in terms of qualifications, I think they're doing them at the moment. So yeah, it's all good.
Okay, so again, in relation to GFAS, I mean, what factors have the firm applied when assessing the competency of the authorised financial advisors?
I mean, first of all, they're all competent because we took them on. So, I mean, that would have been assessed at interview stage. So, yeah, I mean, they're all competent. They just really need these qualifications to meet the minimum requirements. So.
Okay. But other than the qualification, has the competency of each individual been formally documented in your records?
Only when we would have taken them on at the interview process, because we wouldn't have taken them on if we didn't think they were competent. Well, certainly we would have managed them out.
Mm-hmm. Mm.
I'm not stressed, ladies and gentlemen, that was definitely a hybrid. It wasn't one single interview. So the question is, of course, what would we do now? Well, of course, we could consider referring it across to Simon. As Simon was saying yesterday, he expects a certain amount of referrals, but sometimes he doesn't either. So let's go back now and see what Amanda and Dawn thought of what they'd just done.
So that was a bit concerning, wasn't it? I mean, John really seemed to have a very tick box mentality to carrying out his compliance checks, and it doesn't seem like they're being done on a risk-based approach at all. And I really don't feel like he's very likely to be focusing on some of those key compliance risks that are facing ABC at the moment. Really seemed like he had a real lack of understanding about the actual business that ABC does, and he didn't know its client base. So I feel like the management of the compliance risk is very unlikely to be adequate when we look at those files.
Yeah, no, I share those concerns as well. That was certainly the impression I was getting through the answers that we were getting. And I think that feeds through into the GFAS requirements. Again, there seemed to be a lack of understanding there. And from the answer that we got, it doesn't appear as if competency is necessarily being assessed.
No.
Which is a little bit of a concern. Or if it has been assessed, then it was done at interview stage, which is what John said, which isn't satisfactory.
No.
So I don't know how you feel, but maybe I don't think there's any more questions to be asked at this point, and maybe we just take back what information we have and discuss it further back in the office, and then decide what action to take from there, really, what to do.
Yeah, I agree. Yeah, let's do that.
Good.
Right, so this is where, of course, Emma, Louise and I would get involved, and I'm very conscious of time here, so I'll just quickly talk to this slide. But frankly, there are many tools in our armoury when we are faced with such a situation. We could, of course, seek more information. We could just write expressing our concern to the managing director. Sometimes, to be honest, we just sit back and watch, although clearly was something of that nature to happen all in one interview. I doubt very much we would do that. But certainly, we would look at monitoring closely, and that tool there is what we nickname enhanced supervision. So you could certainly be expecting a lot more meetings with us in such a situation. In any respect, one suspects that what would be communicated would be a shock both to John and indeed to his board. And at which point, ladies and gentlemen, it's time for questions.